In this video, we explain how to understand price ranges. After a significant rise or decline in price, a phase of consolidation and temporary pause often occurs. During this process, price accumulates energy and creates fractal contractions and expansions, while still remaining within the same price range. One way to identify a price range is through candlestick formations. Two candles with opposing forces that open and close at the same price can be a sign of a concrete wall. Once one concrete wall is identified, the next one can be found after the completion of a zigzag cycle in the opposite direction. If another concrete wall is found there as well, the movement between them can be defined as a price range. If the price remains trapped for another cycle within this range, it is considered range-bound. A price range that contains the price and allows even more energy accumulation. This represents a very strong opposing force that prevents price from continuing its move. Like a concrete wall that price cannot break through. The two candles. What happens now is that I add the COG to the price range. This is the internal price range around which price is expected to oscillate, meaning it creates liquidity until a directional bias is chosen. Once the range breaks either to the downside or the upside, this is the range in which price will perform a range retest by oscillating around the equilibrium. As we can see, price has broken the range to the upside, and now we wait for the retest within the COG range. Now, after the oscillation, we can see that price has formed a wider price range, but the original price range remains valid. This allows us to identify the fractality of price in its movement. All this gives me is a new COG, which allows me to understand where the center of gravity of the price range is. Now that we have a range-bound market and its COG, the expectation is oscillation around it until a direction is chosen. The probability of an upward move increases, since the original range was broken to the upside and we now have a graded price range, meaning overlapping price ranges that create an upward progression. For the purpose of the video, I mark where healthy oscillation occurs, and where price fails to oscillate, preparing the equilibrium in terms of liquidity for another return. Only after a healthy oscillation can we gain further insight into the direction of continuation from the center of gravity. After price violates the top of the range again, I update the range and update the COG. The expectation is for reactivity and another phase of oscillation, also due to all the liquidity that has been built within the price range. Reactivity usually continues until a price expansion occurs that does not return to the range, at which point we will start looking for a new price range. Price ranges can be understood this way on any time frame, but it is recommended to work on the 4-hour or 1-hour charts in order to identify daily or weekly price ranges. On these time frames, the structural behavior of ranges is much more stable. The same logic can also be applied to lower time frames such as 15 minutes, 5 minutes, or 1 minute. However, instability is significantly higher on lower time frames because the building blocks of price contain fewer transactions, making their equilibrium less balanced and more prone to noise.